Okay.
Like seriously?
Yeah.
About what time we were just based on the so long notes.
Okay,
Yeah.
we're finally got it recorded. Yeah, it takes a minute to get that thing going. Okay, I have a question before we commence with the material for tonight, since I was not here when the last exam was given. Did anybody not finish the exam?
I was very close.
I was close.
I left like
I was very close.
9:15. Well, 5 minutes before.
Like, who finished with 30 minutes left?
I finished at like 8:30.
Yeah.
Mm-hmm.
Okay. All right. It's very difficult as a professor, and I'm pretty new to teaching, figuring out how long to make an exam. On the one hand, you don't want exams to be too long, but on the other hand, if they're too short, then the students can't miss very much before they don't have a good grade. So, to me, this material is difficult. So if you have too much, by the end, your brain is not functioning properly. So I don't know. Okay. Then your next exam will probably be a fairly similar length, maybe a little bit longer. Okay? So, I know that doesn't tell you much, but expect something very similar. Some multiple choice questions, some short answer questions. It will be similar. And I did not realize your exams were printed front and back, so that will not happen for this next exam. So if you need more room, you can just turn over and write on the back. Apologize about that. I did not tell Eric specifically, and he's just trying to save trees, which is good, but not at the expense of not having enough room for your tax problems. So you will have. See, the thing is, when I had this class last semester, one of the things the students complained about was that on the exams there was too much space, and some of the questions involve like facts from above, and then they would have to flip back and forth to get to the facts that they needed to answer the questions that have multiple parts. So I don't know which is better. Either you have it all close together where you can see it all at one time, or you have more space to write your answers. So I think the best thing is to try to get it close together, but give you a back page. So if you need to extend it, you can write on the back. And please show your work, because I do get partial credit. Okay? All right. Okay, so last time we were discussing the redemption rules under Code Section 302. We got through discussing 302B2, the substantially disproportionate test. And if you remember, this test is very mathematical. You do the math, you either pass it or you fail it, period. That's it. Now remember, you only have to meet one of these tests to be classified as a sale or exchange. If you are not classified as a sale or exchange, you default into the distribution rules under Code Section 301, which takes you into that distribution waterfall. First, dividend to the extent of E and P, right? Then a return of capital, then capital gain. Okay? So I'll just pose this question to y'all. I didn't ask this last time, I don't believe. So if your shareholder is an individual, are they going to want sale or exchange treatment or dividend treatment? What do y'all think? Generally, no. Generally, an individual is going to want sale or exchange treatment. Why is that? Because, well, so currently, the tax rate is the same on qualified dividends as long-term capital gains. It hasn't always been that way, but currently it is that way. So the tax rate is the same for individuals. But the difference is, with a sale or exchange, they get to, their gain is calculated by reference to their basis, right? So if they have a $30,000 payout in a redemption and a $10,000 basis, if this is classified as a sale or exchange, what will be their gain? $20,000, right? So that's what they're going to pay taxes on. Now, if this is classified as a 301 distribution and the corporation has ample E&P, how much are they going to pay taxes on? $30,000, right? If it's all categorized as a dividend. Okay? So that's why an individual cares. They can typically reduce their gain, or they can reduce their amount that's taxed, their base or whatever, by the amount of their basis. So an individual is going to prefer sale or exchange treatment. What if you have a shareholder that's a corporation? What are they going to want? What do y'all think?
301,
That's right. Why is that, you think?
because they get tax less.
You ever heard the dividends received deduction?
Yeah.
So if a corporation receives a dividend from another corporation, depending upon the ownership, they do not have to include that dividend in income. It's not taxable. Okay? So if you have a corporation they're going to prefer dividend treatment, generally. If you have an individual that's a shareholder, they're going to prefer a sale or exchange treatment. Okay, so the next 302B test that we're going to discuss tonight is 302B3, a complete termination. So last time we spent a fair bit of time talking about the attribution rules under 318. So the beauty of 302B3 is that it turns off family attribution. Only family attribution. So remember last time we talked about entity attribution. Partners to partnerships, partnership back up to partner, corporations to shareholders, estates to beneficiaries, right? All those rules still apply. We are only talking B3, the complete termination, turns off family attribution. This matters a lot because what we're saying here is if you have a shareholder and they really are redeeming all of their shares in a corporation, but they have another family member that is still a shareholder, they may not be able to meet these other tests. But if they are really redeeming all of their shares, this code section says we can turn off family attribution. Let's take a look at 302B4 in our code. No, I'm sorry, B3. It says 302B3. Subsection A shall apply, which means we get sale or exchange treatment, if the redemption is in complete redemption of all of the stock of the corporation owned by the shareholder. Okay? Now, if we look at 302C, 2, says, for determining termination of interest, in the case of a distribution described in B3, which is where we were just looking, Section 318A1 shall not apply if, so there's an if. So if I was you and I was looking at your code, I would circle that word if, because that means we have certain things that have to be met for the family attribution rules under 318A1 to be turned off. Immediate, so this is 302C2A, one little I. This is the first requirement. If immediately after the distribution, the distributee, which is the shareholder, has no interest in the corporation other than as an interest as a creditor. So we have no interest other than a creditor. The second requirement, the distributee does not acquire any such interest within 10 years from the date of such distribution. Hold on. And there is an exception. Look at the code in parenthetical or in parenthesis. What does it say is the exception? That's right, other than stock received in inheritance. The exception is inheritance. And then the third requirement is known as the look-back rule, okay? Which only applies, look-back rule, which says that the shareholder or the distributee cannot have acquired the redeemed shares by another 318 related party. Okay, 10 years. 10 years. And there cannot be any, so I guess what I'm saying is, for this to apply, they can't have acquired from any 318 party, and tax avoidance must not be a principal purpose. So for this one, to run afoul of this rule, you have to basically, it has to be, one, tax avoidance has to be a principal purpose of the transaction, and two, you have to acquire it from a 318 related party. And if you were not here last time, anyone here not here last time? Okay. Make sure you get the outline material from D2L if you do not have it, okay? So, I didn't bring any more today, I forgot. So to run afoul of this rule, both these things have to be met. They have to acquire it from a 318 party, and tax avoidance must be a principal reason for the transaction.
But they can't acquire from a 318 party.
Yeah,
Okay,
that's right.
sorry, I thought you said something else.
Yeah. So let's talk first about this first requirement, no interest other than a creditor. So courts and the IRS have been very, very strict on this. And there are a lot of notes in the chapter on this. I think there's maybe a case or a rev rule or two. And if you look at the outline material that I gave you, I discuss, these rules. Basically, it really is pretty strictly construed. You can't be an employee, not acceptable. A director, definitely not acceptable. Even an independent contractor, not acceptable. There are a few things that are allowed. You can lease property to the corporation. That's okay, so long as arm's length rent is paid. Arm's length meaning what an independent third party would pay. That's okay. Let's see. It says there's a case. This is Rev Rule 59-119, which basically said the distributee, so the person who is redeemed, basically had a nominee on the board of directors of the corporation. And they said, not okay, you run afoul of this rule. Anything else to mention under this? Oh, okay. The book does talk about, on page 223, deferred payout. And what they're talking about here is, okay, so we say that they can be a creditor. So the redeemed shareholder can still be a creditor. Now, as part of this, so my first job right out of undergrad, I have a degree in economics, was working for Bank of America in downtown Dallas as a risk analyst for large loans. And one of the things that I quickly realized with these large loans was that as a creditor, we had a lot of rights in the company. We had a security interest in a lot of properties, which meant if they defaulted, we could go foreclose on a lot of their properties. If there was a big decision that had to be made, like a merger, we could have a say in that. So creditors often have a lot more rights than you might think they have in the company. So there's a discussion in the book, and it's an interesting discussion, talking about at what point do you cross that line between a regular creditor and having too much interest in the corporation. And one of the things that they discuss is the term of the loan. So then the case law is kind of all over the place on this. What is an acceptable term? Some case law says the term of the note can't be longer than 15 years. There's been another case that says 20 years is acceptable. So depending upon which jurisdiction you're in, that answer may be different. There's definitely case law out there to say that payments can't be based upon profitability of the corporation. Another thing they talk about related to deferred payouts. Hold on, I'm looking for something specifically. It says that under this case, Lyle versus Commissioner, the tax court found that there was a complete termination where the redeemed shareholders were to be paid for their stock over a 20-year period. The shareholders retained their voting rights pursuant to a security agreement. The stock was held in escrow and could be returned to the shareholders. And the shareholders continued to serve as corporate directors and officers. So the court here concluded that they were directors and officers really in a name only, and really all of their rights were tied to that security agreement. So the point of this is, I want to tell you that this standard is very fuzzy, and it depends upon which circuit you're in on how it will be applied. Just know that creditors do have rights in a company. It may be that this creditor surpasses the rights of a normal creditor, and if that's the case, we have to consider if they've run afoul of this requirement here. Okay. Okay. There's also a discussion in the book of waivers of attributions of entities, which is discussed in 302C2. Well, let's see exactly where it is. Oh, 32C, which is at the bottom of page 36, special rules for waivers by entities. So this is meant to cover a specific situation, and I'm going to draw it on the board so you can see what it's talking about here. So if you have a trust, and then you have a C Corp, and we'll just say that this trust owns 50%. And then we have a beneficiary of the trust, beneficiary A, and then we have beneficiary B of the trust, and these two are siblings. And then B also owns 50% in C Corp. So what we're saying is, okay, if we completely redeem A out of this trust, then according to the attribution rules from trust, they are still considered as owning shares through B, basically. But what we say is, if all the parties agree, we can basically agree to waive the attribution right here, so that A is not going to be considered to own the shares of C Corp through the trust. So this is kind of the specific situation that this is meant to deal with. Another thing on this 10-year, well, really on all of it, if you decide to use 302B3, you have to file a form with the IRS, so with your return. So, what is the name of that form? Does it say in here? It probably talks about it. It talks about it in the regs. But there is 302C283. Oh yeah, it says under 302C2A, 3 little i's. It says that the distributee has to file an agreement to notify the secretary of any acquisition described in clause 2 and to retain such records as may be necessary. So you do have to file this agreement saying that you are going to use these complete termination rules. Okay, so that's pretty much it under this this topic. I will tell you that if you are looking at a problem on your exam or real life, whatever, and you see a shareholder that is being completely terminated of all of their interest in the corporation, the test that you want to go to first is this one, okay? Because then you don't have to worry about any of those attribution rules. And you do have a problem on your exam where there is a shareholder that is redeemed of all of their interests. And I remember last year, I had students who were sitting there going through the calculation for substantially disproportionate and trying to figure out the attribution involved there. And really, all you have to do is say they're completely redeemed. They don't have any shares after their redemption. So long as these things are met, it's going to be categorized as a sale or exchange. Okay, so if you see a complete termination, this is where you want to go first. Okay, always. Okay, so let's look at a problem. On page 227, we're going to do problems 1 and problems 2. You're not responsible for problem 3. It's on page 227. So we have Randall Corporation, which is owned by Chuck, 25 shares, owned by Allison, which is 50 shares, and then owned by John, which is 100 shares. And all these parties are related. I think it says it's owned by John, John's daughter, and then Allison's daughter, son Chuck. Okay, so part A. Randall redeems Allison's entire 50 shares for cash. Does this qualify under 302B3? Yeah, we don't have any evidence. What's your name?
Austin?
Austin, okay. We don't have any evidence to the contrary to believe that she is a creditor. You know, she's not, we don't, assuming she's not going to acquire the interest in 10 years. Yeah, okay. Now, if you did not have 302B3 and Allison was completely redeemed, under this 302B test, would she satisfy it? Substantially disproportionate. Why is that, Shelby?
She would still own some of her father's shares indirectly.
Yeah, she would actually still own 100% under the attribution rules. She's going to be attributed to the shares of her son and her father. So she would definitely not pass under 302B2. We haven't talked about B1 yet, but we will. So, but I'll tell you, she wouldn't satisfy this one either. Okay? So this is really the only route for Allison to take. All right. Next question, B. Same as A above, except that Allison fails to file the agreement required under the code. What do you got? Nope, the agreement has to be filed. All right, next question. Same as A, except that the price paid for Allison's shares is contingent upon future profits. What do y'all think?
She has interest in the company's profit, so she's more than a creditor.
Essentially, yeah. So that's actually discussed in the regs under 302-4D. 1-302-4D. Okay. Randall redeems D. Randall redeems 20 of Allison's shares for cash on January 1st of year 1, and the remaining 30 shares for cash on January 1st of year 2. So we want to know, what do you think you might want to know with this problem? We have two different redemptions. One is in year 1 and one is in year 2. So if both of these redemptions are pursuant to a plan, to one plan, to get her completely redeemed, then they're both going to be, we can look at them together, right? And say, okay, they're both going to be satisfied as a complete termination. If they are not a plan, we don't have enough facts to know yes or no. If they are not seen as a plan, would the second redemption still qualify? Yeah, right? Because with the second redemption, everything is gone, right? But the first one would not. And we would have to run through the calculations under 302B2 to see if the first one is satisfied here or here. And we'll talk about this one in just a minute.
But it wouldn't count, it would still be wrong for the first year just because she would have the rest of the stuff from the 318s, the rest of the shares from the 318, right?
Yes, you're right,
Okay.
sorry. You were very right. You're right. You wouldn't really need to run through these calcs because of the attribution rules. It's a good point. Okay. Okay, now, same as A above, except that Allison remains as a director. No, definitely not, under Rev Rule 59-119. Same as A above, except that 2 years after the redemption, Randall forms a new subsidiary and Alice becomes an employee of the subsidiary. What do you think? So no, this is specifically addressed in the regs under -4C. This applies to subsidiaries. They take this very, very seriously. Okay. Same as A above, except that 2 years after the redemption, Chuck dies and leaves his shares to Allison. It's good, right? Because inheritance is an exception, the only exception. Okay. Next problem. So what we're going to do on the next problem, I am not going to read all this. So I just want to take a couple minutes. Everybody please read through the facts and then we're going to talk about it.
Can I ask? So if they meet all those rules, then it's a sale or exchange for them.
That's right. Yep.
Okay. And if they don't, then it's a dividend.
Yep, we fall into the default rules.
All right.
That's right. Okay, so let's talk about this problem. So we want to know, is this plan going to work as a sale or exchange? So the first thing they're going to do, Betty and Bill will give 30 of their 150 shares to Junior to provide him an ownership interest in the corporation. What do you guys think about this? Is it okay? So remember, we have that 10-year look-back rule, which says if you acquired the shares from another 318 person and tax avoidance was the principal purpose of the transaction, you cannot use 302B3. So long as what? That's right. So long as tax avoidance is not the principal purpose of the transaction, it's okay. The first thing is okay.
So since they're providing him with an ownership interest, they're trying to not really do taxes, it would count.
You're asking me if that is enough of a business purpose. Is that what you're asking me? I would sure argue the heck out of it,
Okay.
right? And you want to make sure when you have clients in your office, I mean, what I've done in the past is I don't come up with business purposes. That is fishy. The client has to tell me, what is this business purpose? They have to be the ones who articulate it, and I want to articulate it in writing, okay? I like to they email me and say, this is our business purpose. Make sure you have that documented. You want to cover your butt, right? But the client has to come up with the business purpose. If you're coming up with it, that's not good, you know?
Mhm.
So, okay.
So it doesn't matter that it's not a full redemption for 302B3 to apply?
Well, what we're doing is, we're just determining if this, if this is going to make Betty and Bill run foul.
Oh, after all of this?
Right, after all,
Okay,
so that's all we're
yeah,
doing.
yeah.
I agree, it's a little funky the way it's written, but we're just going through the terms of their plan and making sure there's not gonna be an issue with
With each
complying
one.
under B3.
Okay,
That's
gotcha,
right?
gotcha.
So, okay, and the next requirement, B&B will redeem their remaining 120 shares for $50,000 plus a note at market interest payable over 20 years and secured by an interest in the assets of the company. Additionally, B&B will agree to restrict dividend payments, limit new indebtedness, and refrain from taking certain extraordinary corporate actions during the term of the note. So what do you guys think here with this one?
They're a creditor.
Seems like they're a little bit more than a normal creditor.
It's iffy. It's a, like I said, it's a fine line, it's hairy, it depends on what circuit your client is in as to what the courts will say on that. The fact that it's a 20-year note, kind of iffy. If it was me, I would say that's a little too low for my comfort. I would put it at 15 years. The fact that they have say in, you know, under the security agreement, they have rights over, you know, making sure there are no extraordinary corporate actions, or that in itself is pretty normal for a creditor, for a big loan, to have say in that kind of thing. It seems like it's crazy, but it's true. So, but it's iffy. It's a hairy standard. Okay. 3, Betty and Bill will continue to lease the manufacturing plant to B&B under a lease which has a rent escalation clause dependent upon the consumer price index, and they will grant them a 5-year option to purchase the plant at an appraised fair market value. What do y'all think here? Is this one okay?
No, because don't they have to have, doesn't that make them have an interest in the company, like
So,
a certificate?
this is one of those things where courts have said is okay. It is okay to lease property to the corporation.
Even with the rent escalation based off of the.
That's what makes it okay, because then they'll be paying the rent's going up for them.
Yeah,
Oh,
it makes it more arm's length. I don't think it has to have a a rent escalation clause in it, but it makes it even more okay. Let me see. Hold on. Where where it specifically addresses this. Yeah, it says, the service will permit this is at the bottom of page 10 of my outline. The service will permit a redeemed shareholder to lease property to the corporation on an arm's length basis, provided that the rental payments are not dependent upon corporate earnings or subordinated to the claims of general creditors. Okay. Will Betty and Bill's redemption be classified as an exchange? I'd say yeah. There's that one iffy point with the loan. Maybe, maybe not with that. But if you take all these things together as a whole, it's probably okay. Probably. There, it is blurry. Not for sure yes or no. So suppose they establish a managing consulting firm after leaving B&B. What do you think about that? Okay, that's not okay. That's considered to be an independent contractor, and even that's not okay. It's not likely. Okay. All right.
So those are the only questions on the test that you can ask us, like if it's okay or not, or are you gonna make us say if it's okay or not, and then make us do the distribution, that type, like do the math afterwards? You know?
So, okay, that's a good question. If you determine that it is met under this or any of these, you don't need to keep going, right? Because you only have to meet one of them.
Right.
So if you determine it's met here, stop. You're done. Now, if I specifically ask you, does this qualify as a redemption under 302B2, then you obviously only need to do the math for B2.
Yeah.
But if you determine that one of these are met, you stop. Okay? And I mean, like in the real world, if you're doing these, you know, client's just gonna come up to you with information and they're not gonna say, does this satisfy 302B2? You know, you're gonna have to test all.
the code.
You know,
Yeah.
that's not gonna happen. So, okay. Okay, the next one is 302B1, the not essentially equivalent to a dividend standard. So let's look at 302B1. All it says is subsection A shall apply if the redemption is not essentially equivalent to a dividend. Great, okay. This test is very subjective and very fact specific. Even a lot more so than B3. Most students hate this test, or the students last semester really hated it, because it's not mathematical really. What we're trying to get to with this test, I'll give you an example. Okay, so let's say we have A, and A is a shareholder, and A owns 55% of B Corp. Okay? And then A is redeemed of 11%. Not 11% of her 55, but just 11%. So if you're applying the test under 302B2, before A has 55%. After A has 30, 45, 44, right? Over 89. Just making sure I'm doing my calculations right here. Which equals 49.438%. Okay, So is the 50% test satisfied? Is it less than 50%? Yes, this is less. Now what about the 80% test? So we do 80% times what? What they had before. Okay, 80% times 55% equals 44%. So this number, which is our test number, has to be less than this, is it? No. So the 80% test is not met here. So, excuse me. So is 302B2 satisfied? No, not a sale or exchange under 302B2. But the analysis is not done. Anytime you have a problem and 302B2 is not met, the next question you should ask is, well, what about 302B1? This would qualify under 302B1, and I'll explain why. You have a shareholder who before the redemption has 55%, a majority interest. After this redemption, the shareholder no longer has a majority interest. So, although mathematically they do not meet the stringent mathematical test, in reality, they're losing their controlling power in the corporation. So it would satisfy under 302B1. All 302B1 is basically a catch-all to catch these situations where the shareholder either one really has no control over whether they're being redeemed or not. Like they have a non-voting preferred share. They don't get a say in if they're redeemed. So this is meant to cover that situation. It's meant to cover the situation of a very large publicly traded corporation. And you have someone who owns 0.0004% and then they're redeemed of some of their shares. They don't have a say in that. So it's meant to cover those situations and situations like this, where although people technically under the 302B2 test, they can't meet it mathematically, in reality, if you look at the big picture of what's going on, they really are losing something here. I mean, they're losing something significant. And there is a case, a very famous case, the Davis case, which looks basically at three different things. Basically, it says the elements of a shareholder's interest. The first one is the right to vote and exercise control. The second one is the right to participate in earnings. And then the third one is the right to share in net assets on liquidation. So when we are evaluating whether a redemption is not essentially equivalent to a dividend, these are basically the three different things that we can base our testing or our analysis on. And I will tell you that this first one is really the important one. This is the one you use by far the most. Where these other two come into play is when you have non-voting shares. when you have a redemption of non-voting shares, you can't use this first criteria because they don't have a vote. Where you have to look at are these other two elements to make your determination. So if you look on page 13 of the outline that I've given you, I'm not going to write all these things on the board when they're right there already on the outline. But these are the things that have been found under revenue rulings, mostly revenue rulings, some case law, that have been found to be considered not essentially equivalent to a dividend. And if it's not essentially equivalent to a dividend, then it's considered to be a sale or exchange. Like I said, this is really meant to be a catch-all category to get those situations that don't really fit into anything else, but really should be considered to be a redemption. And some of the ones that are discussed, if you have a majority shareholder that has voting control and loses it, that's a meaningful reduction. So that's the problem that I just did up here on the board. Even if that shareholder is not in control, if they lose the ability to control the corporation by acting in concert with only one other shareholder, then that's considered to be a meaningful reduction. And that's what we're testing, is that meaningful reduction. We want to test the meaningful reduction. And if they do have a meaningful reduction, then this is met. Now, what if you have a pro rata redemption? What does a pro rata redemption mean? It means that basically all shareholders are redeemed the same amount based upon their interest. Okay, so if you have a pro rata redemption of a single class of stock, that is not going to satisfy this standard. Because if you think about it, if you have a pro rata redemption across the board, are any of these things actually changing? Because what we're looking at is the shareholders' rights relative to other shareholders. And if there's a pro rata redemption, nothing's changing. The same thing, if there's a redemption of all of a single class of stock, and all that class is held proportionately, then that is also not going to satisfy again, because what we're looking at is the shareholders' interest really relative to other shareholders. If you have a shareholder that only owns non-voting preferred stock, that is going to satisfy this standard because they don't have control over whether they are redeemed or not in the first place. And let's think about preferred stock, okay? So, with preferred stock, how do they fare when you compare it to common stock under category 2 or 3?
With preferred stock, they always normally get dividends paid out to them first.
Right, and upon liquidation, they'll get their assets first. So when you're looking at non-voting preferred stock, this is where, this is the analysis you're going to have to look at, category 2 and category 3, okay? Because if it's non-voting preferred, obviously it doesn't vote. So if you have a redemption of, so I'm going to back up on what I just said. If you have a shareholder, and let's say all they own, so all that they have is non-voting preferred, and they are redeemed, that is gonna satisfy 302B1 because they don't have a vote. So that's gonna satisfy it. They don't even have a say in if they're a D. But let's say you have a shareholder and they own both non-voting preferred and voting common, and they have a redemption of their non-voting preferred. This is where their redemption is. Now, what you're really going to be looking at is this category 2 and 3. Because if their voting shares aren't changing, then their right to vote is not going to change. So really, you're going to have to look at category 2 and category 3 in order to make a determination. But if all the shareholder has is non-voting preferred, then they are going to satisfy this standard. You don't really have to do an evaluation under 2 and 3. A redemption of publicly traded stock, even if it only reduces your interest a tiny bit, that qualifies because the shareholder cannot exercise control over corporations. There is an exception to that, and that's if the redemption is done basically pro rata. Unless it's done pro rata, then it won't satisfy. Okay, on page 14 of the outline, and let's see, this is discussed in the book on page 239. It's the family discord. So I want to talk about family discord. What that means is, should a shareholder be able to argue that the 318 family attribution rules don't apply to me and my mother because we haven't talked for 10 years. She hates me because I decided to get a degree in accounting instead of nursing or something. I don't know. My dad was very insistent that I become an engineer when I was younger. So naturally that means if there's anything I'm not going to be, it's going to be an engineer. So, but needless to say that I didn't ever even consider it. I was like, no. He should have, not said anything and see what would happen. So, if the question is, can you make that argument of, well, I don't really get along with my mom, or I don't get along with my brother. So should I really be attributed his shares or her shares? We haven't even talked for 10 years. Because remember, what are we trying to get through with the attribution rules? What's the point? To see, okay, do you really still have some control? Well, this is what the courts have said. You cannot make that argument under 302B2. You can't make the argument at all. Under 302B1, which remember is this catch-all, loosey-goosey standard, you could potentially make the argument of family discord. But, there is a but, and it says this on page 14 in my outline. There has to be a reduction in the proportionate interest of the corporation first. So if there is a reduction in the shareholder's interest, only then can you look at family discord to determine if you should turn off the attribution rules. And you can only use it to turn it off under 302B1, not ever 302B2. Okay, so this is what we're going to do. We are going to take a little break and then we're going to come back and we're going to do the problems on page 242 and 243.
I was fine until she did this thing over here.